Welcome back. In this video, we will focus on using Bollinger Bands in our mean reversion trading strategy. Bollinger Bands serve as a crucial tool for traders, providing insights into trends and potential price reversal points. Bollinger Bands consist of three key lines. The middle band, this is the 20-day moving average of the price, showing the average price over the last 20 days. The upper band, this line is above the middle band and is calculated by adding two standard deviations. It helps show the potential upper limit of price movement. The lower band. This line is below the middle band and is calculated by subtracting two standard deviations from it. It helps show the potential lower limit of price movement. Standard deviations measure how far apart the prices are from the average, helping us determine whether they are unusually high or low compared to their recent average. Traders can customize Bollinger Bands to align with their trading preference. For example, change the moving average period. Adjusting the number of days used in the moving average can alter the band's sensitivity to price changes. Adjust the standard deviations. Increasing or decreasing the number of standard deviations affects how wide or narrow the bands are, which changes how often trading signals appear. Given the high volatility levels of volatility indices, it is safe to anticipate regular price swings and range-bound movements. This makes Bollinger Bands especially useful for mean reversion strategies. Now, let's look at an example of how to define your entry and exit points when using Bollinger Bands. Traders look for opportunities when the price touches the other bands. If the Volatility 50 Index price reaches the lower Bollinger Band, say at $247.5, traders may consider entering a long position. This is based on the assumption that the price is likely to revert back towards its mean, which is the middle band and a common exit or take profit level. Conversely, if the price reaches the upper band, let's say around $252.5, traders might consider entering a short position with the hope that the price will revert back down towards the middle band. Alternatively, traders with higher risk tolerances may target exiting their positions when the price reaches the opposite band, the upper band for long positions and the lower band for short positions. Stop losses are typically placed just outside the nearest band when initiating the position. The exact distance from the band for setting stop losses will depend on your risk-reward ratio and personal preferences too. Bollinger Bands are also excellent tools for measuring market volatility. One effective method is to use the bandwidth of the Bollinger Bands as a volatility indicator. The bandwidth is calculated as follows. Bandwidth equal upper band minus lower band divided by middle band. When the bands narrow significantly, it might signal that the market might soon become more volatile. This is commonly known as Bollinger Band squeeze. A squeeze indicates that the market is in a period of low volatility and that the breakout either up or down may be coming soon. We can combine this into our Bollinger Band strategy by only entering into positions when the bands are squeezing. Under this combined strategy, there are two key price scenarios to look out for if you notice a Bollinger Band squeeze. The price is near the upper band. Enter a short position. Depending on your risk tolerance, set the take profit at the SMA, or the lower band and the stop loss just outside the upper band. The price is near the lower band. Enter a long position. Depending on your risk tolerance, set the take profit at the SMA or the upper band, and the stop loss just outside the lower band. We will now explore how to execute both mean reversion strategies on MT5 in the following video.